Hey everybody, my name is Justin, and today we're going to be taking a look at a super investor's portfolio, and his name is Rob Vinall, and he manages a fund called RV Capital worth over $300 million. Now, I first learned about Rob Vinall probably around 18 months ago when Monish Pabrai came out and had mentioned Rob Vinall as a investor to follow that he highly respected. And so I thought that was interesting for Monish Pabrai to say. So I've been following Rob Vinall since. Now, Rob Vinall does have a very concentrated portfolio of around 8 to 10 different stocks in there, but he's not that atypical value investor like a Howard Marks or say like a Warren Buffett. I would consider him more of an aggressive type investor where he's looking for that, more so of growth going out into the future. But 2022 was not a good year for Rob Vinall. His portfolio was down around 55% because of Alibaba, Prosus, and then also Carvana. But hopefully his portfolio ends up rebounding for this year. So we're going to take a look at his portfolio as of the end of Q1 2023. And he did buy a brand new stock, Interactive Brokers, which we'll talk more about in this video. I'm going to do a quick valuation on them, also talk more about what the business does, and kind of dig into the financials of this business from what I've learned over the last couple of days. So hopefully you get some value out of this. If you do, smash the thumbs up button, and let's just jump right into this. All right, so before we jump into his actual portfolio, I just want to show you his website. So this is RV Capital. Rob Vinall is this gentleman on the left right here. It's really neat. If you go to his website, now I'm not affiliated with him at all, just so you're aware. If you go on his website, you can actually sign up and view his letters, and it doesn't cost you anything. You do have to create a login, and then you have to ask permission to receive his letters, or at least get access to those. So I get those when they come out, and I find them extremely valuable, especially when he's looking at new potential stocks in there. So definitely go check out his website. Again, it's RV Capital. I find it very interesting. You might as well too. So let's take a look at his portfolio at the end of Q1 2023. So he only has 1, 2, 3, 4, 5, 6, 7 stocks that show up in his portfolio. Now he does have other ones besides this. We're not seeing, I think he still owns Prosus. In order to show up on this list, he has to own more than 5% of Prosus, which would be really difficult to do since Prosus is a very, very large company. So we don't see Alibaba and Prosus on here, but I do believe he owns those two companies still to this date. At least at the end of last year, he did. But you can see on here, he did sell a little bit of Credit Acceptance Corp, but he added to his Meta Platform position. And then he created a new position, Interactive Brokers Group Incorporated, ticker symbol IBKR. So as of right now, it's around 6% of his portfolio. He added about 200,000 shares. So interesting. So, when I first see this and I see a super investor that, I like, and that I follow, I kind of dig in and try to figure out, maybe why did he buy this particular stock? Because I had not looked into Interactive Brokers. I've certainly heard of them, but I kind of did some research over the last couple of days. Now, by no means am I an expert in Interactive Brokers. I've probably done around 2 to 3 hours of research in total. So that's not, in my opinion, enough to really discern if that is a good investment or not. But at least I'll give you what I have learned so far on them. And simply enough, this is their last investor presentation I could find, which was at their Goldman Sachs U.S. Financial Services Conference back in December. But Interactive Brokers is a platform where you can go basically trade stock. So it is, let's think of like a Fidelity or maybe like a Schwab. Interactive Brokers, to me, how they kind of set themselves apart from other brokers. First of all, they're international. So if you go get signed up with them, they have two different products they use. It's called, one's a light and then one's a pro. So if you're a U.S. investor, you only want to invest in U.S. stocks, the light version might be best for you because there's no commissions with that. And then they have their pro version, which gives you access to everything globally. There are some more fees with that, but also if you're a trader as well, that might be one that you want to go with. But what sets them apart by far is that they've automated their processes by far more than any other broker that I have found out there, and it's really increased their margins, which we'll talk about here in a little bit. But over 99% of their balance sheet is comprised of liquid assets, which means they can easily access those, turn them into cash, or they are cash right now, which is fantastic. No long-term debt. Their balance sheet is actually in really, really good shape overall. They have over 2 million client accounts. In fact, I think as of Q1, it's like 2.03 or 2.08. But their client accounts have been growing very quickly. I mean, you're talking 20, 30% per year that they've been growing over the last, couple of years. So here, year over year account growth, 31%. So it's growing really fast. Now the revenue is not growing 31%. It's been growing, say, around 20-ish%. We'll see here in a little bit. But their accounts have been growing very, very quickly, and they're gaining a lot of ground on their competitors just in general. So versatile platform. You can trade stocks, options, futures, commodities, bonds, mutual funds, ETFs, like a lot of other brokers that are out there. I already talked about their IBKR Pro. They also have their light version now. They have very, very low, margin fees compared to a lot of their competitors. Their interest rates that you can get by just parking cash in there is over 4%, which is pretty good compared to a lot of the brokers that are out there. I talked about before, they've been working on automation. That is, to me, what is setting them apart. Like I mentioned, just because that is absolutely increasing their margins, because it's actually lowering their costs now and going into the future. So it's creating all these synergies for cost efficiencies, which is making the business a lot more profitable. So they're gaining 30% more, clients per year. They're gaining, or we'll say, 15, 20% of revenue per year, but then their costs are actually going down year over year, which is tremendous, which is absolutely tremendous. And this is a chart here that just compares Interactive Brokers against other competitors as far as, their margin rates go. For me personally, I don't trade on margin. I just think it's way too much risk there. I know that some people do, and they can make a lot of money, but you can lose a ton of money too. So if margin is important for you, it looks like this would be a good platform to use. But for me personally, I just don't do that overall. But the total global addressable market, they're saying, $281 trillion, which is absolutely incredible. So they're definitely in a space that is a growing type industry, in general. And they've won all kinds of different awards overall. If we get kind of down here, this is actually pretty impressive. Investor presentation, but Barron's, Investopedia, stockbrokers.com, Forex Brothers. I mean, they are brokers. I mean, they've got all kinds of awards over the last couple of years, being named the best broker that's out there. So certainly, if you do a lot of trading, if you like to get into stocks globally, if you trade on margin, it seems like a lot of those tend to do well if you go through Interactive Brokers, and they tend to have better rates in general. Now, let's take a look more about the financials of this company and kind of dig in to see where they've been over the last 10 years and come with a valuation and see what we can do as far as what the stock should be fair value right now. Now, if I open up my spreadsheet here, so this is basically just a summary. Looking at the P&L, looking at the balance sheet, the cash flow over the last 10 years. Now, I like looking at on a per share basis. So, for example, if we were to look at the P&L, which is the income statement, you can see here, I know it's kind of small. Let me see if I can blow it up for you guys. Probably a little better. All right, so you can see, revenues 2012, 1.1 billion, went all the way up to 3.1 billion in 2022. So you can see that over the last 3 years, revenue has grown 12%, 23%, 15%, and that's fantastic. That's fantastic growth overall. However, I like to look at on a per share basis because their shares have grown actually faster than what the revenue has. So if we go to like balance sheet, for example, and we take a look at their shares, their current shares. This line right here, you can actually see over the last even 3 years. So you can see here they've gone from 90 million shares all the way up to 103 million shares over the last 3 years. So they're actually growing faster as far as the number of shares that they are issuing compared to the revenue and some other numbers. So that's why I really like to look at on a per share basis. So from a sales per share standpoint, they've grown on a compounded annual growth rate, 6% per year over the last 3 years, 7% over the last 5 years, 2% over the last 10 years. From an earnings per share standpoint, over the last 3 years, 8, 10, and then 16. So that's 3, 5, and 10 years, and so on. So when I do that, even though that their accounts have grown, 30% per year, you're looking at revenue growing, 15 to 20% per year. We're not seeing that on a per share basis. Still growing pretty good, but certainly not compared to those other metrics. Now, return on equity has been really good for this company. It's gotten better over the last several years. You're talking, 12, 16, 14, 13, 16, 16. So over a 3-year basis, 15%, over 5 years, 15%. Anything over 10% is pretty good. Again, over 15%, that's really good. Over 20% is absolutely fantastic. So that's really good. Now, as far as a debt standpoint, their balance sheet's in a really, really good place overall. So, their EBIT over net debt is actually negative because they don't have any long-term debt. They have plenty of cash, so it's not an issue there. Debt to equity, I usually like to see between 50 and 75%. So it's higher than that, but overall, it's fine. Now, as far as the multiple goes, I'm looking at market cap versus EBIT. EBIT is essentially operating income. So this is really low because their operating income is actually very, very high versus what their market cap is, which is good. So it is a very, very low multiple. You're talking about a 3.9 over the last 3 years on average. And over the last, 10 years, talking about 3.2. But it has been going up overall. And then their margins are absolutely fantastic, but I really wanted to point this out because they're growing because of their automation that they're putting into this business, and because their costs are going down per year compared to their revenue. Their margins are getting better. So back 10 years ago, you're talking 48%, operating margins, and now they're at 66%. In fact, when I did my research, there's a number of analysts out there that are suggesting that they're going to get into the 80 to 85% range of operating margin, which is absolutely incredible over the next several years. And if they can do that, that will just absolutely bolster their bottom line. No doubt about it at all. In fact, we take a look at what analysts think for this company, over the next, several years. From a sales perspective, they think they're going to grow 16%, net income around 34%, and then operating income around 28%. Now, that's not a per share basis. That's just strictly sales, net income, and operating income. But that's still really, really good growth. And what also tells me that they're still going to get more efficient as far as their SG&A expenses go. So if we go to their P&L, you can see, for example, they did 3.1 billion last year, 2.7 billion as far as total revenues go. But as far as operating expenses, if you look at 2022, you're talking around $1 billion of operating expenses, 900 million in the year prior to that. So from a percentage basis, 34% of their operating expenses are compared to their revenue, and if it should go down, would be my guess next year. That's still 34%. Interesting. Okay, so yeah, we're kind of seeing that trend down. So 37, 39, 38, 34, 34. So I would expect that to continue to go down throughout the years. Let me actually bring it back further. Yeah, so 52, 48, 44, 43, 44, and down. So, that's really interesting. So that does also indicate that their margins are getting better, and we can see that overall. Now, if we take a look at, as far as a valuation for this company, I'm going to first look at two different, ways. And the first one is a margin of safety calculator. And this is really just trying to give me kind of a buy price and just kind of gives me a quick topside view if the stock is around a decent value right now. And so what this essentially does is, let me blow this up real quick. is looking at earnings per share, and then I am trying to calculate what I think as far as a growth goes for this company on the bottom line, and then doing a discount rate, and from there getting a target buy price. And so I'm getting actually a $73 target buy price based on this information. Now, as far as earnings per share goes, I calculated myself. I looked on Yahoo Finance and it had like a 2.84, but like at 2022, I come with a 3.69. So I think a 4 is pretty conservative because it's been going up. I mean, you can actually see it's been going up year over year. So I think a 4 is pretty conservative for this valuation. I think growth 15% is pretty conservative, and the discount rate of 2.75 is also pretty logical. And the discount rate is more looking at kind of a treasury rate on a like historical basis. I know it's higher than that right now, and I get that. But that's kind of like the average historical there. But another way you can look at this too is looking at operating income for the business. And that's what this one is all about. So I'm actually projecting out sales over the next several years. So I'm saying they're going to grow about 10% per year on average over the next several years, going at 2027. Operating income is going to grow from 65% last year up to 80%. I saw forecast to 86, 88% during that same time frame, no joke. So I'm going to give them the benefit of doubt that they're going to still continue to create synergies, more cost efficiencies within the company. And so their operating income is going to grow 15%, which is pretty much in line with what I said here as well, too, with the growth of net income growing around 15% as well. So as far as the multiple goes, I'm using a 4 because we saw that before here. The last 3 years around 3.9, and it's been around 4ish the last 3 years. So I think that's pretty conservative there. So doing that, based on that, I get an intrinsic value of around $80 right now, and it's worth $81. So from these type of assumptions, it's not showing that it's great value. So this one's telling me to buy the stock at $73. This right here is saying it's $80. Now this is at an IRR of 15%. So if you want to use 10% instead, I get $100 share price, but I'm just trying to be conservative with the market, with inflation and everything else going on. So from these type of assumptions, it does not look like it's a buy right now. But again, I'm not a expert in this company at all right now. I've only read one 10K. I've only listened to one earnings call. All right. So as you can see from my assumptions, I don't think International Brokers is a fantastic buy right now, but those are my assumptions. If you think that, the growth is not going to be 10% per year on the top line, maybe it's going to be more like, 15 to 20%. You think operating margins are going to be better than what I showed on there. It might make a lot of sense. Keep in mind too that, the IRR that I was using around 15%. So just trying to be really conservative as much as possible, especially in today's market and just where the economy is right now anyway. But there's a lot of super investors that own Interactive Brokers. Rob Vinall is not the only one, and it certainly intrigues me. It doesn't look like it's a bad business. It's definitely a growing business for sure. What does concern me though is that the number of shares they're issuing is actually a higher rate than what say revenue is growing right now. Maybe that will, tailor down in the future, but certainly over the last, few years, last several years, they've definitely grown as far as number of shares outstanding, in general. And, their management is very optimistic about the growth. A lot of analysts are too. They're suggesting that they're going to continue growing at 30% as far as their clientele, the number of accounts that they have. And they've some of the analysis and some of the reports I read are suggesting that they're going to have over 50 million customers, a decade, from now. And right now they have 2 million. So obviously, if all that pans out, this may be a really great buy right now. Based on what I'm seeing, I'm saying I don't know. Maybe it might be at fair value or close to at this standpoint. But I'll probably be digging in more if if it comes different, I find something else. I'll probably throw it on my Patreon so people can kind of see it there. I also offer valuation templates on my Patreon as well, along as access to my Discord channel if you guys are interested. I'll put a link down below. But that's what I kind of think about interactive brokers. That's kind of an update on Rob Vinall's account as well. Be curious from you guys, do you own interactive brokers now? What is the broker that you personally use to trade stocks, buy stocks, sell stocks? I'd love to hear from you guys. Thank you so much for watching. I appreciate it. I'll catch you on the other side. Take care and God bless.